While everyone knows that investing can give you a shot at becoming rich, unfortunately, it is easier said than done. Because if you invested wrongly, you will not only not become rich, your portfolio may jibabun 18 levels underground and you can lose a lot of money. In this video, I will share the 5 biggest mistakes that most beginner investors will make, including me, and give you actual practical solutions on how you can avoid them. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. Mistake number 1. Not investing as early as possible. Yes, investing in the stock market is often scary. Like today up 5%, tomorrow down 10%, then the next day down another 20%. Don't say you lah, I also scared lah. But you know what's scarier? The fact that most of us have to work our entire life and still not have enough money to retire. A recent study found that most Singaporeans believe that they need $2,856 in living expenses per month to retire comfortably by 65. Assuming you are 25 years old now and want to retire by 65 using the 4% rule and factoring in a 2.5% inflation, you will need $2.3 million invested in order to retire. Ho say bo. Thankfully, we have CPF Life, which provides us with money payouts for as long as we live. But despite that, even if we achieve the full retirement sum, you will still need at least $1 million invested in order to retire comfortably. And this is only if you have an investment portfolio that can continue to grow every year, yeah? Because if your money isn't growing, it will be nom nom nom, get eaten up by inflation. You will run out of money during retirement and you will need to learn how to eat grass by then. Then some of you may point out that the market is at an all-time high now. Wouldn't it be better to wait for pullback before I start investing? Well, yes, but no. Studies have shown that all-time highs tend to lead to more all-time highs. In fact, JP Morgan found that if you invest at all-time highs, you will typically get a higher return as compared to investing on any day. Now, of course, the market may not always go stonks and go up all the time, right? A pullback could always happen. But ask yourself this, if you don't even dare to invest in a good market, what makes you think that you would dare to invest in a bad market when everything is crashing 10, 20% or even 50%? So there's never a perfect time to start investing in the market. And here's one thing that I've learned. Your greatest asset when it comes to investing is not money, but time. Because the longer you wait to start investing, the more money you would have to come up with later on. For example, if you invested just $100 every month for the next 45 years with an 8% return, you will get $500,000. But if you I might wait for another 5 years before you start, you will only end up with $335,000, which is a whopping $165,000 difference. And this is considering the fact that you only invested an extra $6,000 in the first 5 years. In fact, the sooner you start investing, the easier it gets later on. For example, with a 7% return, you will need around 8 years to reach your first 100k. But then to get from 100k to 200k, you will only need 5.1 years. And subsequently, the next 100k's becomes easier and easier to achieve. But before you be like, but I don't have a lot of money to invest, that's perfectly fine. Because most trading apps nowadays let you start investing with as low as $5, which is probably even cheaper than your 2 meat 1 veggie chai fan. So just do it. Don't let dreams be dreams and start investing today. The next biggest investing mistake a beginner can make is trying to time the market. Yes, I know that's the saying of buy low, sell high, where you buy right at the bottom and sell right at the top and earn the maximum profit. But how do you even know where's the low and where's the high? Like, is this the low? How will you know this is the high? Are we at the high now? Will it continue going up or will it crash back down? And even if the market performs very badly that year, it can still end up giving really good returns, like in 1998, 2003, 2009, 2020, and so on. Sure, you may get lucky once or twice and manage to time the market. But unless you are Fatco or Nancy Pelosi who can time the market perfectly every time for the next 30 to 40 years, you will likely end up being part of the statistic which says that 90% of traders either lose money or just break even. Because more often than not, people who try to buy low, sell high, end up doing it the other way around, where they buy high and sell low. For example, JP Morgan found that when the market is crashing really hard, most people tend to sell right at the bottom. And when the market is rallying very hard, most people tend to buy right at the top. Like, if you just miss the 10 best days in the markets over a 20-year period, your returns would have dropped by more than half. Miss 20 best days, your returns would drop by half again. And if you miss the 40 best days, you might as well don't invest already, because you will start losing money. And to make matters worse, the best days in the market usually happen right after the worst days in the market. For example, the market crashed super hard a few times during the end of 2008, but then the market also rallied super hard right after. Same for the March 2020 crash, where the market crashed really hard and quickly recovered after that. Likewise, there was also a mini crash in early August this year due to the yen carry trade unwinding saga and recession fears. But the market immediately recovered right after that. So one easy way to avoid timing the market is by setting up recurring investment on your broker to consistently dollar cost average in no matter what. Market up, you buy. Market down, you cry a bit, then you buy more. Because as long as you invest consistently no matter what, and if it's a good stock, of course, it will go up over the long term. But in order to show you how easy this is, I'll be doing a little experiment where I'll be dollar cost averaging my own money into QQQ via Moomoo Singapore. In the stocks page, I can tap on the 3 dots on the bottom right, then tap RSP. What's nice is that Moomoo Singapore is able to deduct the funds directly from my bank account and perform automatic currency conversions for me. I can then invest with as little as 10 SGD or 5 USD, but I will go with 100 USD. As for frequency, I can choose investing from every trading day all the way to every month. But let's just go with investing every Wednesday. Then I'm done. I'll be sharing the result every month, so stay tuned. Fun fact, Moomoo Singapore has a RSP calculator which shows you what return you would have gotten if you had been consistently dollar cost averaging all this while. And speaking of Moomoo Singapore, in their latest welcome promotion, you will get to earn up to $1,034 worth of welcome rewards. This includes a 6.8% per annum guaranteed returns for up to 30 days on your first 80,000 SGD with Moomoo Cash Plus. Please note that Moomoo Cash Plus is an investment product. This is not comparable and is different from savings deposits. Principal is not guaranteed, and up to 30 days of 6.8% per annum is guaranteed only during the promotional period. Investment in any capital market products involves risk and the risk to lose principal. Up to 4 stock bundles of the top 5 traded US stocks worth $70 each and an Apple share worth $287, plus up to $20 cash coupon exclusive reward when you sign up using my link. Holding period and buy trades apply. But with that being said, if you really itchy fingers and want to time the market, you can also set aside some cash to buy whenever the stock is near its intrinsic value. For example, according to Guru Focus, the fair value of Nvidia is at $74, whereas FinChat thinks it's closer to $74. So if the stock ever crashes back down to that level, you can consider adding more. The next mistake that some beginners will make is to invest the money that they need in the short term. For example, money that you are saving up for your wedding 1 year later, or money that you need to buy your new home 3 years later. Don't ever invest that money, as you will never know when the market will crash. Because if you ever lose your wedding money right before your wedding, like this guy, later your wife runs away, then you know. His wife didn't leave him, just in case you are wondering. A study has shown that if you only invest for 1 day, there's a 45% chance of losing your money. Invest for 1 year, 25% chance. Invest for 3 years, 15% chance. Basically, the longer you can hold on, the lower chance of you losing your money. And guess what? Market crashes usually happens when times are bad. Like, what if your boss suddenly fires you and the market crashes at the same time and you don't have emergency funds, or you will end up having to sell investments at a huge loss. Then you might say, but my money is sitting there doing nothing like a lazy bum. For this, you don't have to worry. There are a lot of ways to earn a return on your money with as little risk as possible. For example, Moomoo Singapore currently has a promo which is giving a 6.8% per annum yield for up to 30 days on your first $120,000. Then there's also Moomoo Cash Plus, which is currently giving around 3.6% yield on your idle funds, or Chocolate Finance, which is giving a 4.2% per annum yield on your first 20k, as well as HSBC Everyday Global Account, which is currently giving a 3.4% interest in September. So you don't have to FOMO and invest everything into the stock markets, because there are a ton of ways for you to earn a return on your money while having little to no risk. Next, the other very common mistake that a beginner will make is investing in something that they don't understand, then pray that the stock goes up. This typically happens because either they saw a stock go up or they saw some random pepe pumping the stock and just want to FOMO in. But here's the problem. These stocks tend to give the highest return before the run up, and by the time you have heard of the stock, there's barely any returns left. Or worse, if it's some random meme stock, by the time you bought in, you'll be buying in at the peak, and the stock gives you a big fat middle finger. Now, even if it is a good stock like the S&P 500, it may or may not be good for different investors, because everyone's situation is different, and each of us have different age, resources, and risk appetite. For example, someone who is in their 20s would be able to withstand S&P 500 crashing down by 50% because he still has a very long investing time horizon to hodl and recover from the crash. But if you are an old apet or old ama in your 60s and this happens to you, you'll be like, and may even lose your retirement money. So never blindly copy others and only invest in what you understand. Then you may say, but I don't even know where or how to research stocks. For this, you can start at places like the company tab in the Moomoo Singapore app, where it will tell you what are the company's financials, operating data, financial estimates, and so on. The main thing you want to look out for is, can the company raise their revenue over time, and can the company consistently increase their net income over time. Besides that, you can also check out what other people say about the stock, whether it's on YouTube, Seeking Alpha, or anywhere else. But again, take everyone's opinions with a pinch of salt and try to come out with your own independent conclusion, because not everyone may be right. But if you either have no time to do all this research or are just lazy, the best alternative is to go with a globally diversified index fund like VT or VWRA. You won't buy the wrong stocks if you buy all the stocks. Last but not least, the next biggest mistake an investor can make is they go all in on one stock and don't diversify their portfolio. I have to admit, I used to be like this, where I would go super heavy into a stock, Tesla, thinking that it will change the world. But after being humbled by Mr. Markets over and over again, I now know that that was a very dumb idea. That's because I have no control on what happens in the company. So if the CEO decides to talk nonsense on Twitter, or if they came out with a bad product, or if competition catches up, or the stock will crash, and you can say bye-bye to your dream of retiring with the stock in 10 years time. In fact, more than 1/3 of the stocks that were good enough to get into the S&P 500 were kicked out in just 9 years. So the chances of you picking bad stocks is extremely high. So if you can just spread your eggs out a little, like buy some good companies here, buy some good companies there, you would have a much higher chance of doing well. But this will give me a lower return. For this, you don't have to worry, because if you did your research well and pick the right stocks, you would outperform the market. Otherwise, again, if you are too lazy to do your research, it's best to just stick to ETFs, as they will give you the diversification that you need. But here's one thing to take note of. Even though some ETFs look diversified, they are still concentrated in terms of sector, industry, or even country. For example, SLK, which focuses solely on the US tech sector, or SOXS, which focuses on the semiconductor industry. So if you're only investing in this, and if the tech sector or semiconductor industry does badly, you will GG liao. So always make sure to diversify your portfolio as much as possible. Anyway, that was a quick review on what mistakes an investor can make and how you can avoid them. Hopefully, you found this useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.